let's talk about cash on cash return. Now, a lot of investors are still confused by what's the purpose, what's the meaning of cash on cash returns, how does it apply to my situation, how do I calculate cash on cash return, what's the big picture. We're going to do a deep dive on this and hopefully we can resolve your concern. All right. So cash on cash return. What does that mean? Cash on cash return means that how long it takes for your annual net cash flow, how long it takes to recoup your down payment. In this scenario, total down payment, right? Initial cash invested, 31 grand, right? Down payment, 25% down payment, your loan cost and your closing costs equal 31 grand, right?
Correct.
So when you buy a cash on cash return means, okay, let me go back to the first slide. Cash on cash return is net operating income divided by the total cash investment. I know it sounds very technical, but let's go to a real example. I know what you guys are thinking. What does that mean? Net operating income divided by total cash investment. We will find that out. Once again, an investor don't want to buy on this low price point, high cash flow, real market. A cash on cash return is important to you. However, if you look at the hybrid market in the South and Southeast, when you buy a higher price point, a cash on cash return is not that important in the overall scheme of things, right? Let me dive deeper. Let's go over the Midwest market. These fourplex, I know I keep saying this fourplex of 104, which is a mind-boggling. This $104,000 in the Midwest market could be a single family home, could be a duplex, could be a triplex, could be a fourplex, whatever, right?
That's true.
This is just an illustration, right? These are educational purposes. So cash on cash return in this case is 33%, which is absolutely way beyond the benchmark. The benchmark for Midwest type properties with TCRA market is probably around 10 to 15%. To get anything higher than 10 to 15% on the cash on cash return, as in this case, 33%, this is absolutely mind-boggling good. Agree?
Absolutely. That's incredible. That's really amazing. So basically you're saying it's going to take about a little over 3 years to recoup your initial investment.
Exactly. Now let's dive deeper. Let's go through number by number.
Okay.
The total down payment is 31 grand, right? When it's all said and done, this is your monthly net cash flow, right? How do I divide the monthly net cash flow? 859, which is absolutely mind-boggling good monthly net cash flow. To determine that, you use the 6.8%. I know some 30-year fixed rate mortgage financing, 25% down payment. And then you use the gross monthly rent for all 4 doors, monthly rent, or in this case, annual rent, right? And minus all your vacancy factor, maintenance, taxes, upkeep, whatever, then equal monthly net cash flow 859 multiplied by 12 months. So your annual net cash flow at the end of the first year, around $10,318, right? And net cash flow. So 10,318 divided by your total cash invested, which is 31,000. 10,318 divided by 31,000 equals
33%
cash on cash return at the end of the first year. So do the remaining calculation, which you already done, Julie, how many years it takes to recoup your entire down payment, your money that you put down.
A little over 3 years.
3 years means 33% means 33% plus 33% plus 33%, which is 99%, essentially 100%. In this case, Julie, when you're able to recoup all the risk that you put in upfront on this down payment scenario in 3 years, giving a cap return of 32%, what does it mean to you? What is your end result and expectation?
That's excellent. If you think about it, what investment out there can you get all of your investment back pretty much in 3 years? Any type of business, most businesses take between 3 to 5 years just to turn a profit. So now everything that you've invested, you've gotten back From their point, it's gravy.
Absolutely. I agree with you. At the end of 3 years, you recoup all your down payment. Something, Judy, you and I totally need to emphasize. If you buy and hold for long term, you look at the IRR, the internal rate of return for income property for the next 2, 3, 4, 5, 6, 7, 8, 9, 10, 15 years, IRR continue to increase. When you track your return long term for the next 5, 10 years on each individual property, in this case, you recoup all your money in the first 3 years, all your cash invested based on this massive cash flow. Beyond 3 years, the rest of the money you make, the rental rate increases, the appreciation and tax benefits, and the debt pay down, giving you higher equity. The more the tenant pay down the debt, the return in the 5th, 6th, 7th, 8th year and beyond is quadruple in return. People focusing on the first year or first month cash flow. You don't buy just for cash flow. Over time, I deal with thousands of our investors. I've been doing a very long time. A lot of investors, they bought 1 or 2 or 3 rentals and they have some issues or whatever, have a lot of stress. They couldn't deal with the maintenance and they quit. They do not see how you really benefit. The first few years, some investors, you may not even see the financial benefit in short term, in 2 years. Stay the course, right? Don't give up 3rd, 4th, 5th, and 6th, 7th year. That's we see the amazing financial gain.
You're absolutely right. You do have to look at it as a long-term strategy. Again, it's a mindset. Don't just look at what's happening today. When you look at the total picture over a period of time, you're going to definitely see the benefit. It's just important to stay the course.